So, I mean, it's like $900 million in losses on more than $2 billion in revenue in the last year. On the one hand, you got Lyft coming. You also got Pinterest coming, which has narrowing losses, kind of a different, I would argue, discipline to its approach. How should the public market investor parse through this, make sense of it?
Listen, let's face facts. For the last 10 years, we haven't had an IPO market. We've had a lot of companies staying private longer because there was a lot of money available in the private markets. We're now getting to the point where these companies have gotten to the stage where they either got to go public or I don't know what they're going to do because they can't keep raising money in the private market, particularly to fund these kind of losses. So the public is obviously a good source of capital. I think there's somewhat of irrational exuberance here in terms of the new IPO market, which I think is going to be here with us for the rest of the year, because they're all names the consumers know, and that's has a big thing. Levi's last week, Lyft going, Pinterest.
You said Uber. Irrational or rational?
Irrational.
Irrational.
Irrational. Alan Greenspan's famous
yes.
96 quote. So I think that we're in a time where it's going to be a consumer IPO market, consumer brand IPO market. Consumers get excited. They call their broker at Schwab or wherever else or online. They send them a note, and they want to have a piece of it. That's exactly the way it used to be in the last crazy IPO market.
Sounds like a recipe for a lot of people making some bad bets. So what are the metrics in this wave of IPOs in particular, while people are starry-eyed about names they know, what are the metrics that people should be paying special attention to?
Yeah, but the interesting point is I don't think they're paying attention to any metrics.
I know, but what should they be paying attention to? Is it cash flow?
How about profits?
Profits, okay.
How about dramatic reduction in losses so that the companies can become self-sustaining?
But they're focused on growth rates, Alan, to be fair, and a lot of them still have growth rates that may not have been quite as high as they were a year or two ago, are still far higher than what you're going to see of any typical company.
When you get to the levels you're at now, it's going to be very hard to sustain those kind of growth rates going forward for a lot of these companies. I'm not picking on any particular one. I just think that what I keep saying is watch the first couple of quarters and see. We're going to have a lot of people buying it. We're going to have flippers, if you remember that word. It's going to be back in the parlance again. And a lot of people will make money, and a lot of people are going to get hit at the high tick and could see a significant drop, particularly if there's any disappointment. And I have no way of predicting how any of these companies are going to be. I'm not an investor, and shame on me. I wish I'd been there, when they were valued at 10 million or 20 million. But when they're valued at 23 billion or 60 billion or 120 billion, you can't afford too many errors.
Which I think begs the question, when so much of the smart money in the private markets is making an exit right now, is this a market top?
Well, I honestly don't think that I wouldn't say. I think that the private market has taken it pretty long way. I mean, think of the capital that's been put in from the institutions. And I think they're at a stage now where it will be very difficult to do another $100, $200, $300 million private rounds with these kind of losses. So I think we've got to, it's appropriate. The public market is ready. The question is valuations, and I don't know. I don't know how you value. I mean, you value it certainly at a multiple of revenues that, I don't know, was it 23 billion? They're saying Lyft is 24 billion.
Yeah, I mean
10 times revenues. It doesn't sound crazy, but I don't know what it's going to look like, going forward. To double your money, you got to go to $50 billion.
Right, but people are making thematic assumptions as well about the growth of ride sharing and what that opportunity is long term.
Yeah, first of all, I've said it, I think here, I'm a VIA user, which is a shared rider user.
Yep.
But I'm hearing in a lot of these rides I've taken in the last 2 or 3 weeks, there's an enormous stimulus that's going on to getting people to use it. 30% discounts, 50% discount.
Lyft has been doing that a long time, too, and I wonder, can they keep doing it after they're public?
Well, I don't know. And the drivers are getting spiffs to get them to work to shift from one place or another. So I think we're in a interesting. I'm going to watch. I mean, I don't have the. Well, I can't. I don't think I can participate in IPOs even if I wanted to, because I'm in a classified category of fiduciary. So, but I wouldn't. I'm more comfortable watching.
got a lot of VC money tied up in these companies, more of it for longer. Now with all of these more mature names going public right now, what does that do for innovation in the next wave of startups?
Oh, I think, listen, if they all do well, it's going to even stimulate it even further. But listen, the private market, the venture market, private equity market is booming right now. I mean, there's so much money anxious to get involved, and there are so many young companies being formed. I don't think there's any shortage of deals.
But to Morgan's point, when you were investing in some of the names that we all know so well, whether it's Office Depot or America Online or Cadence, the private market was not nearly as mature as it is now. These companies stay private so much longer, and a lot of their growth curve, a lot of their greatest growth years now happen as private companies. Yeah. Is that a good thing?
Well, I don't think it's a bad thing. I mean, it'd be hard to have funded. You couldn't have possibly funded a Lyft or an Uber in a public market in view of the capital that they've had to raise. You would
You don't
never
think so? What do you mean? I mean, during the dot-com boom, that's what everybody did.
Yeah,
you
but
came public, and nobody was staying private.
Not in the amounts you're talking about. I mean, I don't know offhand. I haven't.
No, it's many billions, and Uber is, I don't know, what's Uber, 8, 10?
Yeah,
I mean,
or WeWorks. I mean, what's that?
There.
WeWorks did $2 billion in revenues and lost $1.9 billion.
Yeah.
I learned one thing early in my career, that ultimately everything has to be funded by free cash flow. You can't have shareholders forever subsidizing the growth of companies, which has been happening now. And of course, you're going to say Amazon grew that way. Amazon grew, in a somewhat different period.
True.
Than
Netflix has done a pretty good job also
of digital
not putting
models,
up a lot of.
I got to get your take on Apple News Plus, because you've been an investor in publishers and digital publishers, also in Apple. Can this work? This model of pay a $10 monthly subscription, get all these publications that, I mean, many of them themselves were charging nearly that much independently?
I think Apple can do almost anything it wants. It's got a great consumer brand. People trust them. I think this is a concept. We'll see whether it works or not.
But can it work for the publishers?
Yeah, I think it can. I mean, if it gets them greater traffic and, that translates into more advertising, I think it's an interesting experiment. There are a lot of people who are supporting it, as you know, to start out with. And, it's an interesting idea. I think at the end of the day, we got to have subscriptions in news in general. We're an investor in Axios.
Yes.
And Axios has not had any subscriptions yet. It's grown through sponsorship, advertising, and promotion, and events. But ultimately, I hope we'll be in the subscription area also.
You think this is going to push some ad-based players to really get some subscription-based content that maybe they hadn't had before, so they can play in this premium tier?
I think they would all love to have a subscription element. I can't think of any publisher that wouldn't want to have a subscription element. I mean, look at, paywalls are really, been pretty successful for the Journal, for the Times, for a whole bunch of publications. So I think it's going to be, I'm excited about the opportunity. Still, no one else. I think I'm the only person in the world who still likes media companies.
I like media companies.
We've been investing in the podcast. That's to save your job.
For whatever.
We've been investing in the podcast business. We're interested in that area.
Why?
I think they're a very great source of content, and there are lots of ancillary subsidiary rights that come out of the podcast business. And I think that subscriptions will become a part of that business at some point, sooner rather than later.
Just to broaden out a little bit, on the heels of this Apple News, it does seem like you've got tech companies that are now investing in the news business and this idea of human curation. You have e-commerce companies that are now investing to expand their brick and mortar presence. It almost seems like what's old is new again. How do you think about it?
I'm right in line with you. I think there's an irony to it forgive me, I think maybe I said it before, using an ethnic expression, but there's a lot of chutzpah involved in Amazon now opening bookstores. I mean, when you think about it, but I will tell you seriously, almost everyone, we're in a lot of direct-to-consumer plays selling, through the internet, and which have done very well, but almost every one of them is having a store presence. They're all opening one, first a pop-up, then they open a permanent, then they open two. So they're all finding out that being on Main Street is not all bad, and it helps their online direct-to-consumer business as well. They're reinforcing. So I think they're finding out they can't just have an online presence. They need a physical presence as well, which is, I think, great.